Welcome to Inside India. I'm JP Ong, and here are your headlines. President Trump saying he's disappointed that India continues to buy Russian oil, but says that does not derail U.S.-India ties. Help is on the way for tariff-hit industries as India prepares a series of measures to help businesses impacted, including garment makers and jewelers. Indian markets are set to open higher today, boosted by expectations of lower U.S. rates after that big jobs miss. And the Nikkei is outperforming today as the yen slumps. Political uncertainty returned to Japan after Prime Minister Shigeru Ishiba resigned on Sunday after a string of local election losses. Good morning and welcome to the broadcast. And we start once again with a quick look at how Asian markets are shaping up on the first trading day of this week. A bit optimistic for most of these major markets, including that of the Japanese Nikkei 225, now up by about 1.4%. We'll get into that a little bit in a little bit more detail later on. But we are also looking at mainly Chinese markets. Once again, painting a sluggish picture at the start of this Monday. The Shanghai Composite trading just about 0.1% lower, perhaps a little trepidation, a little hesitation ahead of the release of those key trade figures coming from China. There are expectations that Chinese exports might actually come in just with 5% growth on a year-on-year basis, and that the trade balance will also trim down to about $92 billion US dollars. Elsewhere, we are looking at the South Korean Kospi also trading 0.1% higher in today's session, and also some signs, at least, that emerging markets in Southeast Asia are looking a bit more optimistic, including that of the Thai set with a new prime minister, it seems, for Southeast Asia's second largest economy. And our top story this morning, Japanese Prime Minister Shigeru Ishiba stepping down after a series of election losses. Let's get to Lin first to see how markets in Japan are reacting to this news. Lin, I've lost track of how many prime ministers there have been in Japan recently, but let's talk about how the markets might be reacting, for better or worse, to the news that they will have another prime minister, a new prime minister perhaps, in the coming weeks or months.
Yeah, good morning to you, JP. Certainly there's a number of cross currents worth factoring in here. But what we've seen in terms of that reaction is that equities are indeed rallying, right? You have the broader based topics hitting a record, and the Nikkei 225 is not too far away from that as well. And the Japanese currency clearly weakening, giving back a lot of the gains it made at the end of last week. JGBs have been mixed, although when you look at those yields at the very long end, again, we are seeing them moving higher as well. I think what you can draw away from this market reaction, all things being equal and at a very high level, is two things. The first is the expectation that whoever becomes the next prime minister, keeping in mind that this is what we're looking ahead to is the next leadership contest race within the party, and there is no guarantee, given that the ruling coalition only holds a minority in both houses of the Diet, that whoever wins this contest will actually go on to become the next prime minister. Although we also have to factor in the other part of this, which is that the opposition is pretty fractured as well. So we could be looking at more fiscal stimulus because of pretty populist policies is the expectation. And then on the other hand, in terms of the central bank, the Bank of Japan, they have been very cautious throughout the year, mostly because of US tariff policy. But given the political inertia and the vacuum that we're seeing, that perhaps they could be slow playing this further, which means we're talking about lower Japanese interest rates as well. When we delve a little bit deeper, and again, let me highlight the high level of uncertainty here, we could have again a very wide race like we saw last year as well. But the expectation at this stage is that we've got two front runners, very different policies as well. The younger Koizumi, Shinjiro Koizumi, as well as Sanae Takaichi, who's seen as sort of the successor to Shinzo Abe as well.
And the direction of Japan's political leadership will also determine the pace and the direction of possible stimulus support or lack thereof for the world's fourth largest economy. Lin, thank you so much for joining us and for highlighting all the pros and cons and what's at stake with regards to the new leadership shakeup in Japan. And meanwhile, Chinese trade data just crossing the wires. In fact, Emily Tan joins us from Hong Kong with these numbers. numbers. Emily, I hope you're staying dry out there during these times, but we do want to pull you aside for a few minutes just to get an update for us to what trade looks like now in China.
Yep, that's right. Thank you very much, JP. And the numbers just crossing here. We are looking at exports in the month of August rising 4.4% on year. This is weaker than the 5% that was expected from the market and down from 7.2% that was for the month of July. In terms of imports, up 1.3%, and that is far short of expectations and also down from the 4.1% increase that we had in the previous month. As far as its trade surplus is concerned, that coming in at $102.3 billion, also much more than expected. The market was looking at $99.2 billion. Of course, we've been focusing in on rare earths. This is something with the trade war, and the U.S. has been calling on for more rare earth exports or imports into the United States. And I'm looking at a read here for the month of August. China exported 5,791 tons of rare earths for the first 8 months of this year, coming in at 44,300 or so tons in terms of rare earths. So we are tracking what's happening with the Chinese economy. We're looking at this trade truce with the United States, the boost that we have seen in the last couple of months. So with all this front loading, it may be starting to fade, and that is clearly evident in the numbers as we're seeing the growth continue to narrow here in the latest reading coming through for exports for the month of August. Again, that number coming in at 4.4%, down from the 5% increase that was expected. China's container ship departures for the United States was down 25% for the 15 days ending in September the 3rd. That's according to Citi. So we are watching this drop off in the amount of exports going into the U.S. market. Of course, there's being diversions into other locations like ASEAN as well as BRI countries. So we are watching out for that. Declining exports to the United States for 4 consecutive months, not including this month. So we're going to be watching out for any latest data. And we are looking here at the trade surplus with the United States coming in at $185.8 billion. That's according to Customs. And that's for the first 8 months of this year. For August alone, the trade surplus with the United States coming in at $20.3 billion. That's versus $23.7 billion in the month of July. So we are watching here the latest trade numbers to come through, and we are looking at the market reaction as well. JP, it's back to you.
A storm outside your window and a barrage of numbers to deal with regards to China's trade figures. Emily Tan, thank you so much for keeping us up to date on those latest trade numbers from the Middle Kingdom. And zeroing in on Thailand this time, we're seeing the Thai markets are opening in the green today. This a few days after they got their third prime minister since the 2023 elections, and their fifth one if you include the 2 caretaker prime ministers since former Prime Minister Paetongtarn Shinawatra stepped down or was suspended back in June. His name is Anutin Chanvirakul, actually, who is the former health minister of Thailand during the COVID-19 crisis and the leader of the conservative Boomjai Thai party, which has the 3rd largest block of votes, actually, or seats in parliament. The way he got to power, actually, is by courting and actually winning the support of the biggest bloc in parliament, the People's Party, which pushed more than 140 seats to support his bid for the prime ministership. But this came with a couple of caveats, actually, among them an agreement that he will dissolve parliament within 4 months and pave the way for a general election later on, and also a decision to hold a referendum on the constitution that was drafted by the military in 2017. So still a lot of political uncertainty, a lot of things for Thailand to sort out, but at least now they have a new driver at the helm, Anutin Chanvirakul, the 3rd prime minister since 2023 for Southeast Asia's 2nd largest economy. And back to Japan, Kaori and Joji is once again live for us in Tokyo to give us more details about Prime Minister Shigeru Ishiba's resignation. Kaori, give us the latest and give us a bit more context as to what drove the resignation of now former Prime Minister Shigeru Ishiba.
Well, he says that he's resigning because he's reached a milestone on the trade negotiations with that executive order coming out last week. But in reality, he was forced out of office because the writing has been on the wall. He's been hanging on by a thread for the last 50 days since the LDP lost in the elections. And these were losses back-to-back elections as well. So we're in a state of huge paralysis here in the Japanese government. We don't know when the leadership race is going to be held. And even if that is held and the winner governor is named, it could be a slog getting it through parliament because it needs parliamentary approval to make that person the prime minister of Japan. So the LDP is in a very precarious situation. And for a party that's ruled ungoverned except for 5 years over the last 70 years, this is really an unprecedented situation. And we could be in this limbo for at least another couple of weeks. The earliest is the start of October. It could last until the end of the month. We are seeing some contenders come to the fore, including the chief cabinet secretary, people like Motegi as well, he had some former ministerial posts. And of course, there are the names that always come up. Koizumi and also Sanae Takaichi, who ran against Ishiba last time around. The problem is getting the parliamentary approval through this process. So that's one issue. And I think it comes at a very difficult time economically as well. People rejected the LDP because they're concerned about bread and butter issues. And you saw the military hardware on display last week. Geopolitically, Japan is in a very difficult position as well.
Kari Joji from Tokyo, Japan, thank you so much for the latest on what drove the resignation of Prime Minister Shigeru Ishiba and the race now for the leadership for the world's fourth largest economy. And the Indian market's also set to come online in just a little bit. Here's what Gift Nifty futures are indicating about 34 minutes before the open. Just looking at where they are at the moment, and based off of compared to the last week's Friday close, actually, we're seeing once again that there are gains to be made. It seems based on what Nifty futures are foreshadowing at the moment. Mind you, that the Nifty 50 actually is on a 3-day winning streak, but the gains on Thursday and Friday were rather muted, actually. So we'll see if this actually continues as a trend for India's equity markets. Currency markets are closed today, though, due to a bank holiday out in India. And India Prime Minister Narendra Modi is skipping a virtual meet of BRICS leaders later today. Foreign Minister S. Jaishankar will represent India instead. The summit, hosted by Brazilian President Lula da Silva, will see China's president deliver a key address. So discussions are expected to focus on the impact of U.S. trade policy, with Brazil and India facing the highest tariffs, about 50%. Russian President Vladimir Putin is also expected to participate. Over the weekend, President Trump criticized India again for its Russian oil purchases, but ended on a slightly positive note, highlighting his friendship with Prime Minister Narendra Modi.
I'll always be friends with Modi. He's great. Prime Minister, he's great. I'll always be friends, but I just don't like what he's doing at this particular moment. But India and the United States have a special relationship. There's nothing to worry about. We just have moments on occasion.
And Indian Prime Minister Modi reciprocated Trump's statement on the special relationship that India and the United States share. Despite the recent differences, New Delhi continues to say it is engaged with Washington, D.C.
Well, I think Prime Minister Modi obviously attaches enormous importance to our partnership with the United States. And where President Trump is concerned, he's always had a very good personal equation with President Trump. But the point is, look, we are engaged, we remain engaged with the United States. And at this time, I can't say more than that. But that's really what I would say.
Meantime, despite those 50% tariffs and President Trump's disappointment, Indian Finance Minister Sitharaman saying that the country will continue to buy Russian oil. In an interview with Network 18, Sitharaman explained the rationale behind the decision.
Whether it is Russian oil or anything else, it's our decision to buy from the place which suits our needs, whether in terms of rates, logistics, anything. So where we buy our oil from, especially being a big ticket foreign exchange related item, where we pay so much out of our pocket, highest in terms of import, we will have to take a call which suits us best. So we will undoubtedly be buying.
And this all happened against the backdrop of OPEC Plus's decision to raise output once again. A quick check of these oil markets show that futures of whether it be WTI or Brent could continue to inch higher after that decision. At a weekend meeting, the oil producer group agreed to lift production by about 137,000 barrels a day starting in October. Now, it's a smaller production raise than in recent months and returns many of the group's producers to near maximum supply capacity. Vikas Dwivedi is a global oil and gas strategist at Macquarie Group to help us, and he's here to help parse through OPEC's recent decision, also all the recent geopolitical and market moves that have shaped the direction of oil markets so far as we see it so far in today's session. Vikas, thank you so much for joining us today. Before we get into the outlook for oil from Macquarie, and based on all these things we're going to try to calibrate and calculate at the moment, I do want to get into to discuss the emerging flashpoint of India buying Russian oil and the U.S.'s displeasure, as you heard from President Donald Trump a while ago. It's the latest wrinkle in global trade because India continues to say they will continue to buy Russian oil for the benefit of their consumers. The U.S. continue to try to pressure India at least to drop that actually. What kind of volatility is this introducing into the oil markets at the moment?
Yeah, great question. It's introducing a lot of volatility in terms of the supply uncertainty from Russia. Like India is the second largest buyer, and there's only really two big buyers of Russian crude that are China and India. India buys roughly 1.8 million barrels a day, and it's roughly about what they export in refined products as well. So it's a big part of their refining business. It's a big part of their crude selection. Their refineries are designed to run very similar types of crude that Russia produces. So there's a lot of fit there for them to go elsewhere. There are other crudes, like from the Arab Gulf, but it's not optimal. And I think they're standing their ground on saying, like, this is something we need to continue to do. And obviously we know President Trump's displeasure at that. So market participants are getting whipped back and forth. You know, will India back off? Will Trump back off, right? Who's going to blink first? You know, we actually think in the end, India will go down a little bit on Russia, like their imports, and then just let the water settle down and see where everything is at. But we really doubt that India will go to zero Russian oil, and we think they'll continue to buy it and risk sanctions and other tariff-related blowback from the United States in the process.
Okay. Hear me here, Vikas, because I want to go into assess the possible risks and possible flows from a decision. Let's say that India decides to back off on buying Russian oil and reduce it by, say, 80%, for instance. As you mentioned, they'll have to go to other sources for that particular crude. Could this actually create squeezes in the oil market that could show up in higher oil, actually, because now they'll have to compete with demand from these other places that they used to not go towards? So what are your thoughts there?
Yeah, it will create some short-term squeezes. Eventually, the history of the oil market is the barrels find a way back in. No matter who is sanctioning who.
It's liquid after all.
It's liquid. It's literally liquid. It's very fungible. And there are so many sanctions remote entities that have been set up over time. It's the ultimate cat and mouse game, and the barrels seem to find a way into the market. They may be offline for a little while, you know, a few weeks, a few months until everything is set up, the machinery is set up to get the barrels back in. So we think it will create some shortages and some squeezes, but they won't last. And, you know, in the end, we don't think it's something the United States actually wants. We don't think they want the Russian barrels offline. You would lose about 2 million barrels a day if nobody could buy Russian barrels. That would take the price of oil to an extremely high level while the Trump administration is trying to fight inflation, trying to make a case for rate cuts. This would go the wrong way in a big way. And if you cut Russian barrels, you've run out of leverage on Iran. You can't then cut Iran by 1 million and Russia by 2 million. Oil would be well over $100 a barrel. I think that would be a massive setback for the goals that the Trump administration is trying to achieve.
It also highlights how tricky these things are because you're trying to at least put pressure on these regimes or these countries through these oil sanctions. But again, you're actually forcing a lot of these developing nations like India to at least forego energy security, for lack of a better term, and confront rising oil prices. And maybe one of the things also is that, hey, you know what, we can comply, but we need an alternative. How difficult is it going to be to create an alternative if you start to see Russia perhaps pushed out? Could the vacuum be filled by the Gulf region, by the U.S. shale oil producers, in a quick enough fashion to make this feasible? I mean, basically, just how difficult is it going to be to impose these sanctions and make sure people comply?
Yeah, let's use 2 million as a starting number. If Russia gets squeezed out, it would be challenging, and it wouldn't be timely. The fixes coming from U.S. supply growth or OPEC would not be timely enough to prevent a really big rally in oil. Eventually, making up 2 million, OPEC does have spare capacity. They're bringing it back on now. But even there, from here, it may be difficult for OPEC to bring on another 2 million easily. There's only a couple of countries left that have a lot of spare capacity: Saudi Arabia, UAE, maybe Iraq at the margin. So the U.S. can grow if it gets the right price signal, but the buy side in the U.S., the investors don't want those companies to grow. Eventually, if the price got to 90 or 100, yeah, then you can grow, and the U.S. could do it. But all these things would take really a minimum of 6 months if you could get the price signal today, right? So you would really be thinking probably more about a year of high prices.
Okay, so despite all of these geopolitical uncertainties that matter with regards to oil prices and supply demand in this particular sector, highlight first Macquarie's outlook or case with regards to where oil markets are going. Are you a bit more bearish or bullish despite all of this?
Despite all of the things we've just discussed, we're still bearish.
Interesting.
Because our fundamental supply-demand balances are showing about a 3 million a day surplus, which is the largest surplus we have modeled in 15 years outside of COVID, for obvious reasons. So we're looking for very big surpluses in the first quarter of next year, and we think it's going to keep piling up. But what does that assume? To the point in the heart of your questions, it assumes the Russian barrels don't go away, right? That somebody will be buying them. If India reduces theirs, China will buy more. We don't see a lot of other countries buying a lot more, but China will buy some of it. But in general, we just don't see much of the Russian barrels going away. That's a big assumption in our modeling and our price targets and our supply-demand balances.
Right. It's interesting because the case is bearish, but it seems that OPEC, based on their decision to increase, albeit at a slower clip, doesn't seem to be to have the same outlook. In fact, what they've said is that there's still a steady economic outlook and healthy market fundamentals. I mean, it doesn't seem to jive with the views of the likes of Macquarie, for instance. Why do you think they're seeing this, and perhaps you folks are seeing something else?
Yeah, they've been estimating much better demand growth for several years than certainly we have. We doubt it. It's always possible, but really we think that their demand numbers are maybe too optimistic compared to certainly ours and the market as well. They're probably about 500,000-600,000 barrels a day over consensus on demand. The market is not unhealthy, so we would agree with them that it's not like a catastrophic demand outlook, but it's not fantastic either. We would categorize their estimates as fantastic for demand. I think it's okay.
Fantastic or fantastical? Because one thing is very optimistic, another thing is in the realm of dreams, for instance.
Yeah. I think they are at the high end of feasibility, right? Okay. So does that cross into fantastical? Maybe. They're very good at what they do, so we don't want to dismiss their estimates. But we certainly can't, even if we, really tweak our modeling, we can't get to their numbers.
Right. Because, let me know what you think of this, actually, because something you mentioned a while ago about one of the only places India can source oil if they were to shift away from Russia because of the setup of the refineries or some of the OPEC producers in the Middle East. And I'm wondering, because some people are saying they're increasing production right now despite the bearish outlook to try and capture more market share. Could this also be a signal from OPEC to countries like India that, hey, if they're forcing you to wean yourself off of Russian oil, guess what? I have capacity now to perhaps meet some of these if you decide to go to us as an alternative. What are the odds, or what are the possibilities that this is actually what's transpiring? It's actually a signal from OPEC for India that you have an option to shift to us if the Russian squeeze becomes too much for you to bear.
Yeah, we think it would be if OPEC and the Middle East producers did not take advantage of this to say we are a reliable supplier, we can step in, we can substitute for some of the less reliable suppliers like Russia, they would have missed a good opportunity. And I don't think they're going to miss that opportunity to really push the branding and make sure big buyers like India and China, for that matter, know that regardless of what happens with certain countries, the big OPEC producers are there and they can supply as a good substitute for others that might not be able to from sanctions and what have you.
And it is also in a way to try and constrain, say, potential market share loss to U.S. shale producers that might look at these constraints and go, maybe there's an opportunity for us to perhaps get a little bit more of the pie circa a la 2014, for instance.
Absolutely. Yeah. And I think what's important, they could do it this time without creating a race to the bottom on oil price, right? Because you can now substitute if Russia goes off. Whereas in the past, you had to overproduce and try to kill U.S. shale by taking the price of oil down to $50 and $40 and hurt yourself in the process. Here, you don't have to do that if you're OPEC.
Right.
You can just backfill for the potential loss of Russian barrels.
Because just very quickly, we also got news over the last couple of weeks that we're seeing growing ties, that is, between Japan and India with regards to the energy dialogue, the move towards clean energy. Just how important is this particular relationship, not just to the global energy industry, but also with regards to India's efforts to create more energy security and more viable energy security with regards to these things?
I think it's highly important, and it's two countries that, neither possess a great deal of indigenous resources, but they both possess a lot of technological capability. Mm-hmm. So it's a great venture to get in together for kind of a cleaner energy footprint. The challenge is the technologies they're pursuing right now are very technically difficult, and in my estimation, they're going to be hard pressed to make them work. So in my view, this venture will have to find its way into things that actually eventually work. But what they have on the board right now, generously speaking, it's going to be challenging, the different things that they're pursuing together.
And as we're getting to that particular, that long and challenging road, perhaps there is a space where oil will have to continue to fill in some of those gaps as they get to that cleaner end goal.
Yeah, totally. I think without oil and natural gas, you don't get energy transition, mm-hmm. You get energy disruption.
And that's what we all want to avoid.
And we want to avoid that. We've seen Europe, and we want to avoid that experience.
Indeed.
I just think what they're doing right now with some of the technologies in this venture, it's tough. We'll see.
And a lot more to discuss in our next conversation.
Yes.
Because Vivedi from Macquarie, thank you so much for joining us today and helping us make sense of OPEC's recent moves and the recent oil and gas issues facing India's relationship with Russia and their efforts to buy Russian oil. We'll be back in just a little bit, but coming up, India is planning to support exporters hit by U.S. tariffs. Will a combination of GST cuts and relief measures help offset things? We'll discuss after a short break. Welcome back to Inside India. The U.S. dollar recovering after that big drop following the big miss in the U.S. non-farm payrolls report. Taking a look at the dollar index now inching up and firming itself up at 97.84. The U.S. economy added just 22,000 jobs in August as the administration's immigration policy started impacting the labor market. The unemployment rate ticked up to 4.3%. That's the highest level since 2021. The data is raising concerns about the slowdown in the labor market, with Fed funds futures now pricing in a near certain 25 basis point rate cut at the Fed's September meeting, and near 10% odds for a bigger 50 basis point cut. In an interview with NBC's Meet the Press, Treasury Secretary Scott Bessent played down the jobs report and said the U.S. economy will start accelerating by Q4. Bessent also spoke about tariffs and the impact.
They're eating the tariffs. So, and again, there are numerous companies who are doing the opposite. You know, you're taking these from earnings calls, and on earnings calls, they have to give the draconian scenario. There aren't companies coming out and saying, oh, because of the tariffs, we're doing this. But I can tell you that whether it's Micron or Apple, they are upping their investments in the United States. And, you know, Kristen, if things are so bad, why was the GDP 3.3%? Why is the stock market at a new high? Because, you know, with President Trump, we care both about big companies and small companies, and you're quoting big companies, but the big company index, the S&P, is at a new high.
Hasbro says they're going to have to increase their prices. Goldman Sachs says 86% of the tariff revenue collected so far has been paid by American businesses and consumers. So just bottom line, Mr. Secretary, do you acknowledge that these tariffs are a tax on American consumers?
No, I don't.
Even though you have companies saying they are going to have to increase prices, and given the fact that 86% of these tariffs so far have been paid by Americans.
You're quoting Goldman Sachs.
If the Supreme Court rules against you on these tariffs, is the administration prepared to offer rebates?
So, Kristen, I am confident that we will win at the Supreme Court, but there are numerous other avenues that we can take. They diminish President Trump's negotiating position, but there are numerous in terms of, and remember, this isn't about the dollars, this is about balance. The dollars are an after amount.
Would you offer rebates, though? Are you prepared to offer rebates?
So we would have to give a refund on about half the tariffs, which would be terrible for the Treasury.
We are counting down to the market open in India in less than 13 minutes, actually. And this is how things are shaping up. Still foreshadowing modest gains, actually, based on what Gift Nifty futures are flashing right now. 24,882, about 140 points above the Friday close. But again, despite the fact that they are on a 3-day winning streak, the last 2 days, Thursday and Friday, saw gains actually more flat to the upside than actually robust. And we'll see if the mood can improve, actually, at the start of this trading session. In India, is preparing a package of relief measures to support exporters hit by the surge in U.S. tariffs. In an interview with Network 18, Finance Minister Nirmala Sitharaman saying that the government will help affected sectors.
It is never a situation of one fixated point. It's a dynamic situation where you're moving from one to another with newer players coming in, newer factors coming into play in this scheme of things. This one, you have the GST reforms, which is going to make people understand that they can fetch more things with the same amount of money with which they bought some amount earlier. So it is very clear that industries have been speaking about the tariff and its impact. The government has designed something for itself. We will come out with something to handhold those who are hit by the 50% tariff from the US. This has been said earlier. I've met up with the delegations when I went to Chennai in recent past few days. I have said this there and I will repeat it. Government is working.
So will they be allowed to sell in India, or how do you plan to alleviate their concerns?
No, there is a package which consists of very many different ways in which we want to help them. So we'll wait for the cabinet to clear it. But there is something coming to help them so that this tirade of the tariff is something which they can face. And also suddenly having to look for newer markets is also a challenge, but we'll have to help them out on that.
That's Indian Finance Minister Nirmala Sitharaman speaking to CNBC TV 18 with regards to the support they are planning to offer exporters hit by the Trump tariffs. And Subhadeep Rakshit is the chief economist at Kotak Institutional Equities, here to help us understand what the possible impact will be on the Indian economy that is facing a lot of headwinds, perhaps opportunities even, based on the recent tax reforms. Subhadeep, thank you so much for joining us today. You heard from the finance minister just now about the plan to offer support to impacted exporters in India. Do you think it'll be enough, actually, to help offset any potential blowback or headwinds should the 50% tariffs imposed by the United States continue to stay in effect?
So I think 2-3 parts to this question that we should be answering. First of all, when we are looking at the tariffs and trying to look at what the government has done already, I think it's important to note from the February budget, we had the income tax relief come in, which will have a multiplier effect and hence offset some of the weakness in demand, followed by the GST cut, which will again kind of have an offsetting effect. Our estimate suggests that roughly around 0.8 to 1% of GDP can be the potential benefit, which when you look at it from the context of the tariffs, which let's say, the 50% remains for the coming few months, can offset any kind of, let's say, 0.5 odd % of GDP impact from the tariff can be offset by both the income tax, which was announced in February budget, and the GST cut, which has been announced now.
I think one of the concerns also, Subhadeep, that many actually raise is the possible second-order effects of these tariffs, and yes, it might be impacting some of the sectors that are not the biggest drivers of the Indian economy, but again, because of the number of people they employ, they actually face certain job losses. How do we factor in, or how do we make get a better grasp of what kind of impact any job losses might have? And again, going back to those relief measures, will that be enough to perhaps support some of these companies that are trying to keep balance and make sure they don't fire that many people?
So if you go back to the COVID period, there was a period where job losses were seemingly would have continued for many months. And there was difficulty in keeping the operations running for the companies. And I think one of the template that the government has is in terms of the credit guarantee scheme. And if you look at the credit guarantee scheme given to the MSME sector or the small and medium enterprises during that period, it's a template that the government already has and can utilize in some sense, again, during this period where they can think about bridge loans, they can think about relief measures through guaranteeing some of these bridge loans, postponing, giving a moratorium of sorts, as well as giving access to the domestic markets. That option always remains. So you have multiple ways without really getting into the direct fiscal support, by which you can kind of help the small and medium enterprises. Along with that, you obviously have the option if things really deteriorate and you have mass job losses, risk coming up, you can use the fiscal space too. And I think there is enough fiscal space to give some amount of relief that the companies may require over, let's say, next few quarters, if at all. So my point is that you will have pockets of the fiscal that can be used, as well as the indirect route from the government where we already have seen credit guarantees, etc., which can be used to kind of support the exporters.
So, Videep, you mentioned a while ago, or you already hinted at the possible impact of the GST reforms actually on the economy. Can you help us better understand also what this will actually mean for Asia's third largest economy, and also exactly whether or not this is meant to offset any of those declines from the tariffs? Will it be enough to offset some of those headwinds from the tariffs and net put India in a better place?
Sure. So if you look at the GST structure, prior to the rationalization that has been done, there were multiple rates that were there, 0, 5, 12, 18, 28, and then we have the demerit goods at multiple rates. The simplification that has happened now of just 2 and 1 other demerit rate, I think that simplifies the whole GST structure. So the indirect tax, in some sense, as we should be putting it, the GST reform has simplified both in terms of compliance, one, and second, in terms of pushing products which are, let's say, essential and daily commodities into a lower tax bracket, as well as certain aspirational commodities which are now also at a lower tax bracket. So I think in some sense, the benefit that we derive from, and the government has kind of quantified it, not exactly in FY26 terms, but at least given a base of sorts from FY24 consumption base of around 480 billion. That's the net impact on the GST collections. That could be seen as one of the direct impacts, and then you have the indirect impact in terms of pushing volumes higher. So our sense is that, along with the direct and the indirect, you should be having roughly around anywhere between 0.3 to 0.5% of GDP as a potential benefit. This we have to kind of recognize when we put it in context of the tariff. This is not a 1-day or a 15-day exercise that has been done. The group of ministers, the Fitment Committee, the GST Council deliberations have gone on for over a year and a half now, and there has been an intense exercise that has been going on in the background. It's a different, probably the timing wise, it coincides with the tariff announcement. And also, you can think about it in sort of a support coming in the right time, and just around the time when tariffs are hitting India. But I think the exercise or the background work has been going on for a long time, which ultimately helped in terms of the GST Council, helped them to kind of implement it at the right time.
And can this also be seen as a strong bet on the Indian consumer and its ability to be the one tide that lifts the Indian economy, regardless of what happens and regardless of headwinds, given the fact that the Indian consumer itself and domestic demand remains one of the biggest, if not the biggest, drivers and determinants of the Indian economy? Just how much of this is a bet on the strength of the Indian consumer and its ability to transform that economy?
So this helps cyclically. So the reason why I say it helps cyclically is because if you look at the structural composition of the labor, as well as the kind of labor absorption that we've seen over the past few years, there is a fair amount of structural headwind in terms of income growth, in terms of good quality, good paying jobs that are created. So those are ultimately the structural drivers of consumption. However, the shift that we've seen in government policy through the February budget, when the income tax relief was announced, which obviously helps the top part of the pyramid, or the top to upper middle part of the pyramid, and now the GST collection, which actually helps the entire the consumer pyramid. I think now it is much more broad-based. But yes, if you look at consumption as a driver, which obviously is the largest proportion, both the income tax and the GST relief is in that sense pushing the consumption cyclically ahead. So we should be seeing good couple of quarters of cyclical consumption pickup. But ultimately, I think what drives structurally the consumption or the consumption growth forward beyond just the GST relief or in terms of the income tax relief will be how good how well the pickup in private sector investment happens on the back of a consumption pickup. The global scenario also plays a role. So I think cyclically, yes, these help. Structurally, we'll have to see, because there are certain headwinds that continue still.
And so do spell out for us exactly what the overall forecast for Indian GDP is based on your calculations, and specifically also how much of a hit we might expect from tariffs and how much of an upside we might get from these GST cuts.
Sure. So if our base case for growth for FY26 is 6.5%, our bear case of some sorts, and there can be multiple bear cases, but what we are assuming essentially is the 50% tariff continues beyond, let's say, the next few months. And obviously the positive impact from GST comes in, we should be looking at GDP anywhere between 6 to 6.2%. But these are, at the end of the day, slightly mechanical numbers in some sense, and there are multipliers which can work through in different ways. On the upside, if the 50% tariff does not stay and we come down to 25% or lower, depending on whether we get a trade deal done this year, and obviously the positive impact of GST comes in, we can potentially look at a 6.7, 6.8% of GDP against our base case of 6.5%. Broadly, if you look at the benefits from the GST, that's roughly around, let's say, 0.3 to 0.5%. The worst case scenario from a tariff that we are factoring in is around 0.5% of GDP. So broadly balanced is how I would put it in the worst case scenario for us. And if you're looking at it from, let's say, a much more milder tariff scenario, I think it's a net positive in terms of the base case of 6.5% that we are seeing.
Sudeep Rakshit from Kotal Institutional Equities, thank you again for joining us today and for sharing with us your outlook, that is, for the economy amidst all these uncertainties brought about by the tariffs and also the possible upside from these GST reforms. Appreciate the insights and the thoughts, sir.
Thank you.
Well, India and Israel are moving closer to signing a bilateral investment treaty. Israel's Finance Minister Smotrich is in India for a 3-day visit. He will be meeting his counterpart Sitaraman and other senior ministers. The pact is expected to give investors from both countries stronger protections under global norms, including fair treatment and access to independent arbitration. Smotrich will also visit Mumbai and Gujarat's Gift City. India is laying out a 15-year defense modernization plan that includes its first ever nuclear-powered aircraft carrier. The Navy, which currently operates 2 carriers, will also deploy Indian-made fighter jets for the first time. The Defense Ministry says the roadmap aims to cut reliance on foreign suppliers and boost private-public partnerships. Markets are open now in Mumbai. We'll take a look at some of the movers and shakers after this short break. We'll be back in about 2 minutes. Well, it's been about 4 minutes since the Indian markets came back online and started the new trading week, actually. And we are seeing the Nifty 50 looking a little nifty today, and just a little bit. They're up by about 0.1% at 24,787 points. The Indian rupee also firming up to about 88.13 against the dollar. But mind you that they did hit a new record, a weakest level on record, actually, at 88.16 last week. So we'll continue to monitor where the rupee actually tracks, because they are still near some of those weakest levels on record. A quick check on shares of Bharat Heavy Electricals, or BHEL. The state-owned firm has signed a 10-year agreement with Singapore's Horizon Fuel Cell Technologies. The two firms will collaborate on hydrogen fuel cell-powered rolling stock for India, with the move also marking BHEL's entry into the emerging hydrogen mobility sector. Currently, we're seeing Bharat Heavy Electricals, or BHEL, shares are up by more than 1% so far in the first 5 minutes, that is, of trading out in Mumbai. India's SpiceJet reporting a net loss of about 2.3 billion rupees in its first quarter. The airline says demand was significantly impacted after airspace closures post India's military conflict with Pakistan back in May. Currently, SpiceJet shares, well, unchanged right now at about 34.45. Vietnamese EV maker VinFast is also targeting India, taking on Tata, Mahindra, and the newly launched Tesla. The EV maker announcing pricing for its two electric SUVs, the VF6 and the VF7. The cars will cost about $18,000 to $23,000, competing directly with Indian and foreign EV models. VinFast plans to localize parts, expand dealerships to 27 cities, and scale its manufacturing plant in the country. Now, we all know venture capital and private equity, but there's another asset class that has been gaining steam globally. It's called a search fund. CNBC's digital correspondent Ernestine Siu is here to tell us more. What exactly is a search fund? I'll just get straight to it. Ernestine, tell us more about this.
Yeah, absolutely. Hi, JP. So today there is a major demographic crisis that's happening, right? There's a big shift that's happening where a lot of baby boomer business owners are looking to retire, but they don't have a succession plan, right? So these are your main street businesses. So anything from plumbers to electricians to meter readers, these are your everyday businesses that maybe are unglamorous, but they are very necessary to the functioning of society. And meanwhile, you have this whole new generation of young aspiring entrepreneurs who see this demographic shift as actually a good opportunity for themselves to realize their CEO dreams. And so this is where search funds come in. Let's take a closer look. They don't grab headlines like venture capital or private equity, at least not yet. Search funds are a different asset class on the rise that skip the startup grind entirely. At its core, search funds fast-track the path to entrepreneurship. Rather than starting from scratch, individuals buy an existing company, grow it, and eventually sell it for a profit.
For me, the idea was fantastic because I thought, wow, this is great. I didn't have this startup idea, so it was an opportunity for me to buy an existing business, good opportunity of having a successful exit. Targets of search funds are rarely glamorous, but essential. Think plumbers, equipment rental companies, or pest control. Essentially, small to medium-sized enterprises with healthy balance sheets. These are businesses that are frankly hard to break, and so it's very forgiving for the first-time CEO to learn how to run and operate those businesses. A 2024 Stanford study found that the number of search funds in the US and Canada has quadrupled in the past decade, with returns often outpacing traditional private equity and venture capital.
Venture is so crowded now. Search funds still remain small while growing. The opportunity set is so big.
It's a trend catching fire globally, fueled by a big demographic shift, especially here in Asia. Baby boomer owners are retiring in droves, often without a clear succession plan.
On the talent side, there is a big displacement of young professionals who are in the middle of their career, impacted by AI coming in, business owners who are looking to retire. When you put one and one together, you have a good match. What began as a path to entrepreneurship for ambitious young people has now become a potential solution for the global succession problem.
We live in such a tumultuous time with change happening so fast. This feels like a very safe port in a storm.
So it just seems like a great alignment of interests because on one hand, you have business owners who are looking to retire. On the other hand, you also have this younger generation who's super energetic, who wants to run a company. And of course, you also have investors who are looking to diversify their portfolios and maybe invest in asset classes outside of the typical venture capital and private equity. And if you actually look at the data, over the last 40 years, search funds have actually outperformed private equity and venture capital in terms of returns. And something I just want to point out from what Jason said is that search funds can actually be a great way, a risk-adjusted way for people to become entrepreneurs, because a lot of times these are first-time CEOs or they are aspiring entrepreneurs. So maybe they don't have the capital, or maybe they don't have the experience or even the idea to get started, right? So by raising a search fund by these institutional investors, they're raising the capital necessary to run the business. And a lot of times these businesses that they're buying already have a proven business model, right? These are profitable, mature companies that are typically in the 1 to 5 million EBITDA range. And also their investors become their mentors. You know, a lot of times these investors have started search funds themselves. So they've actually been through the whole life cycle of acquiring a profitable company, running it, professionalizing it, scaling it, and selling it. And they've come out on the other end, and today they are investing in the next generation.
And again, this also along with the growing trend among younger people who want to be their own boss, who see entrepreneurship and owning their own business as the path to financial freedom. It's interesting to see how there's now an entrepreneurship or tech take, at least, or tech tinge towards this particular twist. And we'll continue to monitor how this continues to develop. And if it sets an example for other countries as well. Ernestine, this is one of the more fascinating things I've read from you in recent times. Thank you so much for joining us today, and great learning about what search funds really are. And that's all the time we have today on Inside India, but please do keep watching CNBC. Access Middle East is up next.